So everybody, welcome to the second um, Filter Formulas workshop. Again, this is meant to be interactive, and if you want to ask a question, please feel free to ask at any time. Um, you don't have to type it. You can speak. It's not like a webinar. It's a go-to meeting. Um, I'm also going to break the cardinal rule of doing demos and things like this, and I'm using a new beta version. As I explained before, I'm working on the look and feel a little bit, changing the colors around. The navigation bar is moved, and you now have menus for getting to the different areas of Option Workbench. Everything is still there. It's just a little. You give a little bit more screen real estate to play around with. And actually, the reason that I'm doing this is because there's some new filtering features that I'm adding. They'll be released pretty soon. But since you guys registered for the webinar, you'll get to look at the stuff early. Okay. Now, before I start, if anyone has a question, I think in the confirmation email, it said to email questions. Um, but I didn't receive any. So if anybody has a specific question that they want to address, please, you can ask now, and I'll try to get to it. Otherwise, I'll just get right into it. No questions? Okay. Okay. So as you all know, on any given day, there are over 4,000 uh, optionable equities and ETFs available, and then in addition to that, you have 50 odd indexes, and then a few hundred future contracts that you can use as well that have options on them. Um, so the purpose of the filter formulas and is really to be able to sorry, and then on any given day there are probably 500,000 options that are available also. So the purpose of the filter formulas is to make it easy for you to search through that vast universe of potential trades and find things as quickly as possible. So you don't want to spend hours and hours and hours doing research. You want to be able to do your research as quickly as possible and get right to putting the trades in. So what I like to do is start with somebody's echoing. What I'll do is start with naked puts because there's typically a lot of them, and each day on the strategy zone. So, for example, yesterday at the end of the day, there were 13,093 potential naked puts identified, and that's just in the universe of those several hundred thousand that are available. And even that, that even though it's whittled down by a lot, still a lot that you need to go through. The first thing I want to point out is that the new data is the earnings date. I'm going to have to mute somebody because it's echoing through. Let's see, who is it? Okay, Kevin, I think that was you. So, Kevin and Joe, if you want to ask a question, type it in there, um, and we'll see if we can get to it. I'll try to keep peeking at it so I can see your questions, but there was a lot of echoing going on. Okay, so Kevin couldn't mute his mic, but that's okay. All right, so I muted it for you. So the first thing I want to point out, like as I said, is the new data, which is the next earnings date, and that's available in all the profiles, the spread profiles, and in the option profiles as well. If I go over to equity ETF, you can see it here. It's after that next trade date, and just to explain this a little bit, you'll see what the date of the next earnings is. There's a little check mark next to EQIX here and Netflix, and that means that those dates are confirmed. And confirmed means what I'm doing is using 3 online data sources, and if 2 out of those 3 agree on a date and time, which is next to the date here. It's either going to be AMC as here in Netflix, BMO as over here in Celgene, or NA means is not available yet. So if 2 out of the 3 sources agree on the date and time, then we consider that confirmed, and it'll have a little check mark there. The dates are sortable. The BMO comes before AMC because that's the time of day, and the NA is the earliest part of the day. And the reason for that is if a date is unconfirmed, then it will pick the earliest of the 3 sources to give you a lot of, make sure that you don't sell anything before that earnings date. So that's a really handy feature in both the option profiles and the spread profiles, especially for something like naked puts. So what I like to do for forming a new filter is I basically start from scratch. And a filter, uh, you start out with what is the primary piece of data that you want to look at. So for example, I've been using this DBE Sigmas filter for a while for naked puts, and it's been working out pretty well for me. So I started out with just saying the DBE Sigmas column, which is the downside break even of the excuse me, the number of standard deviations that the downside break even is below the strike price. I'm sorry, the price of the stock on that particular day, and I want that to be greater than a certain number of standard deviations. In this case, I have 1.2. You can change that number. Um, I'll play around with it. If there aren't enough, then I'll make that a little bit smaller. If there are too many, and that's enough or too many is kind of a subjective judgment that I make. Um, then I'll make that a little bit bigger if there are too many. Um, and then here I started using the new next earnings column. So I want the expiration date to be before the next earnings date. Excuse me. So that I won't, sell a put that's after after an earnings date. Um, okay. So if also for selling puts, I want to do that for a short term. So I want the days to expiration to be more than 5 but less than 30. I want to have some meat on the bone. I want at least 50 cents for my put. I want the annualized expected return to be at least 15%. I want the IV percentile, the composite IV percentile, to be greater than the mean percentile. And just in case you're not aware, the mean percentile is here where the histogram changes colors. So I want to sell, again, I want to sell expensive options. The IV factor tells me the percentage premium or discount that particular option is to the rest of the options, to the composite implied volatility. I want a total option volume the day before of at least 1,000 contracts, and I want the IV of the option to be at a 15% premium to the 20-day historical volatility. And in this case, I picked the 20-day historical because I'm using short term. I want to sell for the short term. Okay, so to build this, what I really did was I started out with just the DBE sigmas, and I'll kind of walk you through that how to create the filter. So I just type in the name of my filter. I'll call it new filter, and then so that's now added to the bottom of my list here, and a new blank filter came up. So the first thing I wanted to do, as I said, was uh, filter by the downside break even standard deviations. So I have this blank page here, and I can just start typing, which is what I normally do. But I can also go to the help screen. Sorry, I wasn't there. Okay, and So the first thing I want to do is say that I want those downside break-even sigmas to be greater than or equal to some number. So I can just click on greater than or equal to. Now it's added. Oops, I have to fix that. Beta version. Uh, it's added an expression in here um, that has two operands, and now I can go in and fill in the operands. And I'm just going to show you how to use this help screen here. So I want the DBE sigmas. Uh, oops, I didn't have that in the right place. Sorry. So if I highlight the left operand and then go click on DBE sigmas, it replaces it in the right place. And I want that to be greater than, let's say, 1.25. Okay, so this right now, this right now is a valid filter. And if I click the apply button, you can see I went from 13,093 all the way down to 6,963. So that's the basics of how I would start to create the filter. Now I want to start adding other conditions in here, and so I want all the conditions that I'm putting in here to be true. So I'm going to use the AND function. And I like to have these on a separate line just to make it easier for me to read. And so each one of the conditions needs to be separated by a comma. So I have the DBE sigmas, and if I hit apply again, this is still a valid filter. So I still have the same 6,963 options there. So let's go ahead and use the new uh, earnings date. So I want the expiration date of the option to be after the next earnings, and I'm typing these in as they appear in here, or on the help excuse me, on the help pop-ups that come up when you hover over the sorry, let's do that. When I hover over the symbol, the filter field name comes up, and you see it says DBE sigmas, um, or exp date. But the type, it's case insensitive, so I can type in any case that I want. And then you can see that. So now I cut down a couple of thousand more, and if you look at the screen here, you can see now I have everything that has an earnings date, and it's past the expiration date of the option. Then I just go ahead and start whittling it down more. I'll put in my liquidity filters. So I'll say total volume, and now that's a column actually from the option profile, um, on the from the equity ETF option profile. So I can use any column from there in any spread profile filter as well. And then so I'll just keep experimenting with it and see how much fewer I get. Okay, so I cut down 1,000 or so more of those, and I just keep moving on until I get to a reasonable number. So I won't go through and do all of that. Let me just go back to my DBE sigmas. So this is the final filter that I settled on, and I also added a sort on the annualized expected return. And here I'll click the X to get rid of that. And to do that, to add the sort, I just these are in the order that they appear in the table. So I select annualized expect return, click the add button. There it is. Now it's going to sort in ascending order, but I want to sort it descending because I want the highest return uh, puts on the top. And you can add multiple sort columns. So let's say I also wanted, oops, I don't want to do that. I also want the IV percentile. Um, I can add that, and I want that also in descending order. So now, for things with the same return, it'll sort them by percentile. It's actually probably not going to do very much. So I can also switch them around, and now the primary sort will be on IV percentile, and then by within the same percentile, it would be by annualized expected return. So now if I click the apply button, in a couple of seconds, I go down to 13. Okay, this is a good illustration too because I only got a couple of stocks here. They all have their earnings date, after the expiration date, but the rest of these are ETFs. You can see the SPY and IWM and IBB. IBB is the biotech ETF, so they don't have earnings dates, so they automatically will get included in that filter. And then I can move on from there. Um, okay, I'm babbling on here. Does anyone have any comments or questions about what they've seen so far? Okay, it's all crystal clear. Somebody must have some kind of special filter question that they want to ask. Shalom, I know you. I know you. You have some kind of question to ask. No, I put you on the spot, and you're not going to ask a question. Okay, so the filters you can use in any one of these profiles. Another thing you can do with the new earnings date filter. Um, so I have this post earnings crush filter that I use, and actually I'll change this. So I want to see what earnings are coming out in the next couple of days. So I can say I want the next earnings date to be greater than uh, April 10th, greater than or equal to April 10th, that's tomorrow, and less than or equal to April 11th, which is Friday. And I'm sorting this by the earnings date. Uh, oops, what did I do? Oops, I didn't have the comma. So I needed a comma there. All right, so now I see I have these four things that are coming out with earnings in the next couple of days. It's actually it's already too late for Rad and Family Dollar, Rite Aid, because they're BMO tomorrow. But Fastenal and NQ, I'm not sure what that is. Those are uh, NQ is AMC tomorrow, so I could still put something on, and then uh, Fastenal is Friday morning. So actually, what I'll do is ask you guys a question um, about the format of the date. Um, so this is probably the easiest way to do it. Just type in the date in year, month, day format. But I was also considering, because since all the dates are formatted as the day, the month, name, and the year. And I haven't implemented this yet, but I would, instead of typing the date this way, you could type it as 10 April 2014. I don't know if that's more intuitive. Does anybody have an opinion on that? No, you guys are not a very interactive group. Okay, so I'll put that in. It won't be hard to put in, but I kind of think it's should be there because for percentages, for example, let me fix this date, 2014 0410. So here I have this percentage, the skew greater than 5%. So this actually 5% is the same as saying 0.05. Oops, not 0.005. So those two are equal, and you get the same results. I just think I put that percent syntax in there, or that way of specifying it, because I think that's probably it might be more intuitive to people. Um, so I'll just put that back to 5%. It's maybe a little bit easier to read. Okay, so I got some feedback from Ken. Thank you, Ken. Um, okay, I was kind of hoping that this would be more of an interactive session. Um, that's kind of all I prepared to talk about. Um, so I'm really here to answer questions. Can I explain the composite IV filter? Okay, so here, yeah, is a little mathematical expression that I have here. Um, what I'm doing is I'm taking the average of the historical volatility. So, adding up the the 20, 50, and 100-day volatilities and dividing by three. So that's going to give me their average. And I want the composite IV to be at a 10% premium to that average composite IV. And sometimes I use that. Sometimes I'll just use the 20-day historical. Let's see what that does. It depends on what the action of the market has been recently. That doesn't, so everything is about the same anyway. Um, but that's what that filter is intended to do. Does that answer the question? Okay, good. Does anybody have a filter that they've been using that they would want to share, or has you know in any one of the profiles that's been working for them, or isn't working, and then they're wondering why? Okay, filtering on. Okay, so question is filtering on IV 30, IV 60, IV 90. So I guess that what you mean is that VIX-like calculation. Actually, we don't have that in Option Workbench yet. So the composite IV is sort of another way of thinking about that. All those things are similar to the composite IV calculation. Those numbers are actually on the development queue. They just haven't come up yet. So the IV 30 would be a synthetic 30-day option, or the implied volatility for an option with 30 days to expiration. Um, and 60 would be the 60 day, and 90 obviously 90 days. The composite IV is daily. Yes, that's the composite IV is a weighted average uh, of all the implied volatilities for the specific name, and it's weighted by uh, the distance, moneyness, distance from the strike or from the underlying price. Sorry, um, the trading volume, and time to expiration. So it's kind of a blend of all those different values. Do I use the Parkinson volatility? Yeah, I don't have it in here. I think this is. Um, I use the Parkinson volatility for a gamma scalping filter, which somehow isn't in here. So let's go ahead and recreate the gamma scalp filter. So I'll say I'm going to call it gamma scalp. Okay, and what I want to do is um, I want that Parkinson volatility, PV 20. Let's just start out with, I want it to be greater than uh, the 20-day historical volatility. So I'm comparing apples and apples, and the reason I'm using those short-term numbers is because the Parkinson volatility, I want to gamma scalp. I want something that's going to move a lot in a short period of time. Um, so I guess everybody familiar with gamma scalping? Um, And the Parkinson volatility measures the intraday move, as opposed to the regular historical volatility that everybody's familiar with, which would measure the day-to-day move from close to close. The Parkinson volatility measures the high to low within a day, so it tells you how much something moves around in a day. Because what that tells you that the historical volatility doesn't is, something uh, could gap up and then move around a lot and then move back down to the day before close or very close to it, and you wouldn't know that there was any volatility in that stock during the day because the close to close regular historical volatility wouldn't reflect that, but the Parkinson volatility would. So let's go ahead and just build a filter here. So I'll click the apply button, and I've got 1,400 stocks that have or ETFs that have the 20-day Parkinson greater than the 20-day historical. So maybe that's not a good enough condition. So let's say I want at least a 10% premium over the historical volatility. So I can multiply the historical by 1.1. I want the Parkinson to be greater than that. Um, okay, so now I'm down to 781 of them. Let's just go up a little bit more and say 15%. Okay, now we can start putting in maybe some liquidity filters. Um, so now I'm going to add the and I always like to use total volume as a liquidity filter. And in the case of something that I want to gamma scalp, I want to be able to maybe get in and out a lot. So I'll say 2,500 option contracts a day on average. So now I'm down to 49, and that's kind of a reasonable number so far. Um, but for gamma scalping, you want the theta to be much higher than the vega, and that's something that is more likely to happen for a lower price stock. So I'm going to say I want the price to be less than, uh, let's say, $35. Okay, so now I'm down to 15 out of the 4,000. And these are some things that, recognize some of the names here. BlackBerry, Intel, Zynga, uh, Groupon. These are some things that do move around a lot. GM, JC Penney, Electronic Arts. So these are some things that might move around a lot that you could take advantage of for gamma scalping. And that's a good example of how quickly you can uh, build a filter. As I said, started out our primary uh, criterion was that we want Parkinson volatility to be higher than the historical volatility, and we came up with a good number there. And then we put in some other secondary criteria to help us to whittle down the universe to a manageable number. So, okay, that's how we'd use Parkinson. Okay, can you filter on Vega, Theta? Oh, the ratios, Vega, Theta, and Gamma and Theta ratios. Um, not at this point. What you would do at that point is uh, go in and look at individual names to find those ratios you know that are most favorable. Um, so the point is, and in general, the way you want to think about using option workbench is you start from a kind of a high level. You've got this whole universe of you know underlyings, equities, ETFs, and futures and indexes, and you want to whittle it down to a few that are manageable that you can start doing some real detailed analysis on. So I would find something that that probably had high volume and a high kind of a high volatility. Maybe it was in a high. Actually, I want it to be in a low IV percentile because I want, if the implied volatility goes up, that would help a gamma scalping trade. Because typically, what you're going to do is buy a straddle, and then buy a delta neutral straddle, and then buy and sell the underlying to as the price moves around to keep it delta neutral, and that's how you would make the money on the gamma scalping. To filter on those the ratios of the Greeks would require you know reading in the details, going through the details of all the hundreds of thousands of options, um, to try to find those kind of ratios, and you're not really looking at the ratio of a single option. You're looking at the ratio of a straddle in this case. So would have to build all possible straddles, and that's kind of a difficult a difficult problem to solve in computer science. So this way you can drill down into a handful of things that are likely candidates, and then do your analysis from there. Okay, I just have to continue with the song and dance, I guess. Um, okay, so the next question is, and you're welcome to talk. You don't have to type on here. So it's an IV percentile versus an IV rank. I think they're about the same. I think they're the same thing. They're synonyms. So yeah, the question was, what is an IV percentile versus an IV rank? Um, the percentile is the rank, versus where the composite IV has been over the last 600 trading days. So I think those are synonyms in this case. Rank is an oscillator. Okay. Okay, no, it doesn't implement that oscillator. Okay. Do you have a number of daily sorts you like to do? Yeah, okay. So the question is, are there a number of filters that I like to do? And basically, yeah. There's a popular TV financial TV host that says there's always a bull market somewhere. I don't want to give out a free plug, but I'm sure everybody knows who he is. Um, I like to think that there's always some volatility to sell somewhere, so I usually start out um, with the naked puts, I've been using this DBE Sigmas filter for a while, and I also go into calendar spreads. And actually, a lot of times, I won't necessarily sell a put when I find something in the naked put. Sometimes I'll do a calendar, and actually with this IBB this morning, I was looking at. I didn't actually do this. I just got busy today, and I didn't have time. So let me click on this IBB. Come on, there you go. So we'll go in and take a look at this naked put. Okay, so it's putting in a 10 lot here. Actually, this is the price today. I guess the it was up today, so probably wouldn't have done this one. Um, so let's go back to the profile. This is another benefit of having the new real time data. So the price of this put at the end of trading yesterday was 70 cents, um, but today, um, since IBB went up. Oh, someone was talking. Was there a question in there? No. Okay. I guess IBB went up a bit today, so the market price, the bid, is only 15 cents. And even if I go in here, I market at the mid, it's only 25 cents. So I probably there's not enough meat on the bone for that one, but if maybe let's look at a couple at a strike a little bit higher. 419. So I guess it went up. It went up about $10 today because it's 235 or 230. I think it was 225 at the end of yesterday. So let's go up to 215. All right. So now that's a little bit better. Let's do it. Let's just do it at market at 55 cents. Do 10 lots to make it interesting. Okay. So this is something I might think about, but for 10 lots, $38,000 a margin is a little bit too expensive. So there are a couple of things that you can do um, to reduce that margin. Let me get rid of that one. One of the first things that I'll look at is I'll put vertical at that strike, and I'll usually do like a $10. So look at the 215, 205. Maybe 20 lot of that. That's only 20 cents. Okay, so that's not really that much better. I mean, it reduces the margin, um, and it's okay. It has for a 20 lot you can get $750 credit, and it reduces the margin by about half, and it gives you a decent annualized expected return here of almost 42%. Um, so that's one way of looking at it. Another way would be a put ratio. You could do the 215, 220 uh, put ratio, let's say, and that's probably not going to be very very good because I would only want to do 5 of those. That's about the same margin, um, but I mean, you get actually technically you get better return out of this. So if I was going strictly by my annualized expected return system, then I would probably prefer this one, even though, you know, if the thing goes up, I'm only making $138 on it, but I get a better return than the other two spreads. Um, but what I was actually looking at this morning was doing a diagonal calendar spread where I was going to buy, let's say I was going to buy the 185 and sell the 205. So what I'll do is buy the 205, no, buy the 195 and sell the 215. Okay, so in the calendar spread editor, I picked 195 as my long strike, and so now I'm selling the 205. Oh, sorry, I wanted to go up a little bit higher than that. Let's go to 205. All right, so I'm going to buy the 205 and sell the 215. Um, let's do it for June. I'll do 10 lots of that because that's going to be, you know, a less cost than the vertical spread. Um, Now, so you have a max loss, and it's got a much better return. The only thing I don't like about it is it's got a negative IV factor, so you're basically selling cheap volatility. But also it's up here around 235, and it's got that break even on that side. So what I actually was looking at was only selling 8 of them. Okay, and this one isn't as good as the one I was looking at this morning because it's got this little dip here, but it's got the same kind of general shape as a naked put, more or less. Um, and it's got a break even that's pretty far down there. Plus, even if the thing really, kind of tanks, you're taking a lot less risk. Also, if it tanks, the implied volatility is probably going to go up a little bit. What I don't like about this now is that it's got that little sag here. It's not horrible, but I'm thinking that it's going to stay in this range, which is kind of in the little sag there. So that's the kind of thing that I'll go through. Um, I also do calendar spreads. I have this thing that I call the standard calendar spread. Actually, I incorporated the earnings into this. Actually, in this case, I want I want to sell an option that's after the next earnings date because in this case, the when the earnings date is coming up, the implied volatility of the near-term options is going to be artificially high, and sometimes the whole volatility surface gets lifted, and that'll come down pretty hard after the earnings announcement. So if I click that, I got 30 possibilities out of 4,700, which is a decent thing to start looking at. A lot of these things have earnings that are coming up soon, um, but it's kind of interesting that these May 17s are a little bit inflated, even though the earnings is before that date. That may be something interesting to look at. So those are the kind of daily filtering things that I do. And you don't find everything, something every day. Um, some days there's a lot of stuff to do. Other days, there isn't. And you just gotta just keep plugging away at it. Okay, does that answer your question, Ken? Okay, good. Um, okay, did I miss anyone? Okay. Okay, well,
Hey,
I
Ken.
guess if oh yeah,
Yeah, this is Shalom. I have
hi.
yeah, hi, how are you?
Thank you
I
for
have a problem.
speaking.
No problem. I was concerned that I didn't know how it was going to come across on the webinar, so I usually just type in stuff.
Okay.
You're hearing me okay, right?
Yeah, fine.
Okay, great. So I wanted to follow up on that IV percentile versus IV rank question.
Okay.
Um, from what I understand, IV rank is basically it really depends on the low and high IVs, and based on those numbers, it finds out where your IV is located somewhere in that interval. But the IV percentile does the calculation based on all the IVs in between. So it's a much broader measure than the IV rank, which is more shallow. So if
Okay,
you had
but
an
the Ivy
outlier,
rank, you have to pick a range of dates to find the min and the max, right?
right, exactly. But that's what you're doing. You're comparing the current IV against the min and the max.
Okay. Okay.
So that's considered IV rank, and the only problem with that is that it's sensitive to outliers. So if for some reason there was a low min or a very high max, so
Yeah.
that would skew the results of the percentile or rank measurement. It would really be called a rank, I guess. But
Right.
the percentile would minimize the effect of an outlier high or low IV. Um,
Right. And with stocks, you're going to get a lot of those. Actually, you're going to get a lot of high IVs around earnings. Um, you get sometimes depending on market expectations or uncertainty. Um, the composite IV can be quite high, and actually that I think has to do with um, the fact that the near the money options are weighted higher in the composite IV calculation than the other ones, and those are the ones that are going to be the most affected by some kind of a upcoming uh, you know market event like an earnings announcement or an FDA announcement or some kind of PDUFA trial or something like that. Um, so IV composite IV is a good measure, but it's and as you point out, the rank is another way to do that. The IV 30, IV 60, IV 90. You can calculate it at any number of those that you want. Um, you know, those are all just different ways of trying to get a handle on, uh, you know, what the options are, how the options are priced in general relative to where they've been in the past, right? And any of those numbers really, um, the composite IV, the IV rank, the IV 60, or any kind of like VIX like calculation is really only useful when it's compared to other readings of the same number, right? Just
Yeah.
saying something has a composite IV or an IV 30 of 75%. Well, okay, what does that really mean? Uh, in for today, well, you really need to compare that to where it's been over in the past to say whether that options or those options are expensive or cheap,
Oh, okay, thanks.
right?
Then the other thing, it's not really a question. I was just wondering if this webinar is recorded or not.
Yes, it is.
Okay.
And as soon as we're done, I'll start processing it, and it should be up on the Option Workbench website, within a couple of days. The
Okay.
previous one that I did 2 weeks ago is already there as well, if you want to look at that one too.
Oh, okay, great. Thanks a lot.
Mhm.
Appreciate it.
No problem. Okay, now that Shalom has broken the ice, a million questions are going to come through, right? No. Okay. Okay. Well, then I guess we'll wrap it up. And if you think of anything that you want to know, or suggest something that I didn't cover for the next one, you're welcome to come back to the next one, which will be April 23rd. Just send me an email, and I'll try to include it, or answer your question. Uh, Otherwise, I hope you all enjoyed it, and got something out of it. And I hope to talk to you soon. Okay, thank you all very much, and good night.